Hey guys, what's going on? Jeb here, and in today's video, Bitcoin is broken below the 20 daily exponential moving average. But not only has Bitcoin broken below the 20 daily exponential moving average, we're actually looking at a bearish MACD cross coming in on our favorite cryptocurrency, probably in the next 72 hours. Guys, in yesterday's video, we predicted that Bitcoin was going to fall below the 20 daily EMA and it was going to continue into a longer-term downtrend. So in today's video, we're going to be discussing whether or not Bitcoin has actually confirmed that bearish breakout, and from there, we're actually going to be diving into the Federal Reserve and interest rates. I know. I promise you, you're going to be getting a lot of value out of it, even though you may be kind of bored by hearing about the Fed so much. In today's video, I specifically want to talk about round 4 of quantitative easing that has started here in the year of 2020, and how that's affecting the Fed's balance sheet, how it's going to hopefully be cleared one day or balloon into oblivion, and also talking about interest rates later on. We have quite a lot to get to in today's video, guys. I'm really looking forward to it. I hope you are too. If you do enjoy today's video, please consider hitting that like and subscribe button. It really helps out the channel when you do that. But without much further ado, guys, let's go ahead and dive right on into it. I'll tell you what, there's nothing better than a novelty mug in a time of crisis. Your boy Jeb is the boss lady, apparently. Check it out. I love this mug. Let's get into it. As you guys will know, over the last 3 weeks or so, Bitcoin has been trending to the upside in what I called a bear flag in yesterday's video. We have an uptrending level of resistance along with an uptrending level of support. And yes, Bitcoin did break below the 20 DEMA, but no, it is not technically confirmed to break below our uptrending level of support. So even though we are below that moving average, we are not necessarily broken bearish just yet. Also, on top of that, we haven't seen a whole lot of volume move into the market following that, so we haven't had a confirmed breakout just yet. But that doesn't mean that we're not going to. We talked about all the technicals in yesterday's video that lead me to believe that there is going to be a bearish breakout, one of them being now that we've fallen below the 20 DEMA, another one being the MACD, because as you can see, it is crossing very bearish and is probably going to lead to a bearish cross in the next 2 days or so. Add all of that on top of the rejection off of the 1,000 daily simple moving average, and you are looking at a storm of bearishness. One thing that I didn't mention in yesterday's video, however, is that the MACD on the weekly chart is actually converging bullish. After this weekly candlestick closes, though, that may not be the same anymore. In fact, these lines may start diverging bearish again in about 2 weeks, should Bitcoin enter a sustained downtrend for the next few weeks. The momentum for this market is bearish in nature, so watch out, be careful of going into longs. I personally believe we're going lower. We might not, we might bounce. There's a lot of things going on right now. It's very difficult to predict the market at the moment, so just be careful, you know. That's generally good advice, right? Yeah. Anyway, guys, I want to move on really quick to the halving, and I want to point something out to you. As you probably already know by now, the halving is coming up in less than a month. It's expected to drop on the 12th of May, which last I checked is about a month from now. There was a person on Twitter who pointed out that this is going to be the lowest that the weekly RSI has ever been moving into a halving event. If you look back on the history of the RSI leading into a halving, typically the RSI is sitting at a much higher level than it is right now. For example, the last halving happened over here in March of 2016. Our RSI was already sitting at 55, and Bitcoin still managed to go on a rally, but we're about to move into a halving. We're about to have a halving in about a month, and the RSI is sitting at a very oversold comparatively level of 40. That's really interesting because that means that there is a lot of room to run following that halving. If you study the history of Bitcoin halvings, you may notice that typically when a halving goes through, it actually may be bearish for a week or two, but in general, it tends to be a very bullish thing long term. I'm sure you guys have probably seen this chart more than you've seen the sun in the last couple of weeks, but this chart right here gives a very good example of what I'm talking about. Whenever a halving goes through, Bitcoin normally rallies very quickly. As you can see, the last one happened right here in the 7th month of 2016, and Bitcoin actually fell for a few months, but following that, a 1,000% return happened. The same thing is predicted this time. As you can see, the stock-to-flow prediction for Bitcoin's value sits around $8,500 before the halving. Following the halving, it rallies to 100 grand. Keep an eye on this halving, guys. This one is going to be historical, and I mean that for many different reasons. Number one, what I said with the RSI. Number two, it's the third halving. Number three, Bitcoin's already at a very mature level compared to where it was during the previous 2 halvings. And number four, quantitative easing. As you guys know, the Federal Reserve has already added quite a bit of debt to its own balance sheet to try and fix the problems that were brought about by the 2008 financial crisis. During the immediate aftermath of the 2008 financial crisis and the bottoming of markets, we saw the first, second, and third round of quantitative easing. If you don't know what quantitative easing is, it's a relatively new practice. We're going to get into interest rates here in a second also. Quantitative easing happens when a central bank essentially buys an asset from another bank, like one of the private banks. They hold on to that asset, the bank gets the money, and the asset sits in the Federal Reserve's balance sheet, and it's basically just sitting there. It's a way of injecting money into the economy to try and stimulate it so that more people have more money to go and spend. That's the theory anyway. QE is a relatively new thing and hasn't been practiced for a very long time. It's still very theoretical, and there's quite a bit of controversy around it. Nevertheless, it is one of the biggest tools in the Federal Reserve's toolkit, especially at this point in time, since we never really had high interest rates that we could pull back to ward off the economic downturn that we are seeing now. Whenever the Federal Reserve goes through a round of quantitative easing, it adds money to its balance sheet. That balance sheet is debt that the United States more or less owes to itself. And this number does go into the United States debt, and that starts playing into things called the debt to GDP ratio that I'm not getting into in today's video because I don't want to do a full economics lesson here. For the purposes of this video, I'm going to dumb it down really, really far just so that we can get through this video. The higher the amount of debt the Federal Reserve is carrying on its balance sheet equals bad. Okay, the higher it is, the worse it is. Got it? Good, let's go. As you can see, in QE round 1, 2, and 3, the Federal Reserve bought billions and trillions of dollars worth of mortgage-backed securities and other types of assets to inject money into the economy and to prop up the stock market to keep the economy moving. There's a reason we had a 129-month bull market. You can see the S&P 500 underlaid under the U.S. Federal Reserve's balance sheet. In 2018, the Federal Reserve started something called the Balance Sheet Normalization Program to try and bring that number down, but unfortunately, we only had 2 years of that before the news hit. And now in the span of a month, the Federal Reserve's balance sheet has almost doubled to nearly $10 trillion, and they're talking about adding another $2.3 trillion on top of that, because let's just keep making money out of thin air. It's literally printing money. I mean, there are people whose job it is to print money. I'm serious. Has to come from somewhere. On this graph down here on visualcapitalist.com, by the way, great website, definitely check them out. You can see how much debt was added and how many weeks it took to do so. This is the fastest, quickest, largest round of QE in history by a huge margin. In theory, quantitative easing should help, and there is a good reason to believe why it should help, but like I said, there's still the problem of increasing the debt to GDP ratio and screwing over the country in the long term by adding money to the debt. You don't really want to do that, because if America ever stops being number one, if America ever stops holding the world reserve currency and people start calling some debt, that's not really a good thing. You start losing leverage, especially when countries like Russia have about a 15% debt to GDP ratio and are buying 400 tons of gold while we have 115% debt to GDP ratio. The number's somewhere around there. It's not a good thing. That's all I'm going to say on the matter for now, but we can talk about that more if you would like. Tell me in the comment section down below. There is one more thing I want to talk about. I mentioned interest rates a little while ago, and I also mentioned that QE is a relatively new thing. So how did the Federal Reserve prop up the economy before that? Interest rates. You guys have probably seen me talk about this chart here on Fred before. This is the effective federal funds rate, otherwise known as the Federal Reserve's interest rate that pretty much every interest rate in the country is based off of. Because a bank, whenever you take a loan from a bank, the bank is taking a loan from the Federal Reserve, so whatever they set their interest rate at, every bank has to have an interest rate higher than that if they're ever going to make any money. You can see back in the late 70s and early 80s, interest rates were up around 15 to 20%. If you had money in a savings account or a CD or anything like that, you were making bank. You didn't want to be a homeowner, but if you were part of just about anything federally backed and had the word loan in it, you were probably making a decent amount of money. Ever since 81, interest rates have been continuing to come down. They were sitting at around 5% before the 2008 financial crisis, and as you can see, those interest rates for the first time in a very, very long time were cut to zero to help ward off the economic impacts of the housing crisis. This valley of interest rates right here is one of the worst things that happened to America in the 2010s. We kept interest rates slammed to the floor at basically zero for 7 years. People were buying homes and locking in 30-year fixed-rate mortgages at 3%. Good on you if you're in the real estate market. Good on you if you're investing in the stock market. Bad on us when a crisis starts and we don't have any interest rates to cut to inject liquidity into the market. We started raising interest rates in 2016 and got them up to 2.5% so that the next time that a bear market would come and a recession would come, the Federal Reserve would be able to cut those interest rates, injecting liquidity into the market, because people would want to go spend money on cheaper loans. That's the way that always worked. Unfortunately, the Federal Reserve had already started dropping interest rates in anticipation of a recession coming, and by the time the news came around, we were only at 1.5%, and that got cut to zero overnight. I know this is a lot to take in. The reason this is important is because we never raised our interest rates high enough so that we could cut them to stimulate the economy in a time like this. So what do we do to try and boost the economy? We print trillions of dollars out of thin air. And by the way, I know I'm just talking about America right now. Pretty much, I mean, the European Union, it's the exact same story across the pond. So everything I'm saying about America, very similar things happening in the EU. You guys have negative interest rates in some places. This is a recipe for economic and societal disaster. Not today, not 10 years from now, maybe not even 20 years from now. In a long-term, distant future, there is going to be a time where either China gets more powerful than the United States, Russia gets more powerful than whoever. I don't think it's going to be Russia. Maybe China. Could be the EU. It could be the African Union in 50 years after they've developed a lot. Eventually, if the United States continues being as complacent as it is, they are going to be world powers equal to or stronger than the United States. We've seen the same thing happen with China over the last 20 years. Their economy has multiplied by an order of magnitude in size in the last 20 years. When we're sitting on $50 trillion of debt in the future and we're no longer top dog as far as the economy is concerned, and people start calling that debt, we get put in a very bad place because the politicians are using their 4-year terms to make the most money that they can and get the biggest name that they can and say to hell with the future. But this is where Bitcoin comes in, because if you'll notice something, during this crisis, what's going on? The Federal Reserve is going through rounds of quantitative easing. Pretty much every government on the planet is doing that. Bitcoin at the same time is about to go through a round of quantitative hardening known as the halving. When Bitcoin is going through a deflationary cycle, the rest of the world is going through an inflationary cycle. There is going to be a power shift following this, and I want you guys to be prepared for it. There's a lot that goes into this. Economies are not simple things. Keep an eye on interest rates. Keep an eye on quantitative easing. Keep an eye on Bitcoin. Keep an eye on geopolitics. Keep an eye on economies. Keep an eye on as much news as you can on the world stage right now, because the whole chessboard is being thrown in the air, and where the pieces land are going to impact the rest of this century. This is a major event, and I want to make sure you guys understand that. Anyway, guys, I went off on a little bit of a tangent. There is a lot to talk about. I hope you did enjoy today's video. If you made it all the way to the end, give me the name of a country down in the comment section down below, just so I know who made it down there. Where's your favorite place to vacation? Something like that. Give me something. Let's have a little inside joke here at the end of the video. Anyway, guys, before we go, though, I do first want to thank each and every single last one of you for watching, as always, though, and I will see you guys next video. Peace.
Oh, I got a real good